Hello everybody, I am Abdulwahab and I'm going to discuss about the types of financial markets. Bago natin alamin kung ano-ano ang mga types of financial markets, let us first know what is financial markets. So financial market refers to the marketplace where the activities related to the creation and trading of the different financial assets such as bonds, shares, commodities, currencies, derivatives, etc. takes place, and it provides the platform to sellers and buyers of the financial assets to meet and trade with each other at the price as determined by market forces. So financial market is actually a broad term, and it includes various types of markets where money can be borrowed at a low cost by companies requiring investment. Investors often trade in securities to earn profit, be it in the long term or short term. Depending upon the economy, millions of dollars of money are traded daily in the financial market. These financial markets are regulated by independent regulatory bodies with strict rules and regulations. They have mandatory reporting and compliance standards. Any violation of companies, investors, brokers, banks, financial institutions, or any other authorized bodies can lead to heavy penalties and, in extreme cases, cancellation of license. So types of financial markets. Different financial markets serve different types of customers or different parts of the country. Financial markets also vary depending on the maturity of the securities being traded and the types of assets used to back the securities. For these reasons, it is useful to classify markets along the following dimensions. First, physical asset markets versus financial asset markets. So for the financial asset markets, also known as tangible or real asset markets, they are for products such as autos, real estate, computers, machinery, and other forms of tangible resources. Financial asset markets, on the other hand, deals with stocks, bonds, notes, and mortgages. So sa pangalan pala, makikita na natin kung ano yung pagkakaiba ng dalawa. Yung physical, tangible, nahahawakan siya, nagde-depreciate, like that. Yung financial assets markets deals with stocks, bonds, notes, and mortgages, which is intangible assets. Second is we have the spot markets versus futures markets. Spot markets are markets in which assets are bought or sold for on-the-spot delivery. So, yun nga, spot markets is on-the-spot. Kaya siya tinawag na spot market kasi yung mga asset is nabibili at saka nabibenta siya on the spot. While yung futures markets are markets in which participants agree today to buy or sell an asset at some future date. So for example, ang isang farmer, nag-enter siya sa isang futures contract in which nag-agree siya ngayon na ibebenta niya yung 5,000 bushels of soybeans niya 6 months from now at a price of $5 a bushel. To continue that example, a food processor that needs soybeans in the future may enter into a futures contract in which it agrees to buy soybeans 6 months from now. Such a transaction can reduce or hedge, and the risk is faced by both the farmer and the food processor. Okay, so next is yung money markets at saka capital markets. So money market is where short-term funds are raised through the buying and selling of short-term debt securities, while yung capital market is where long-term funds are raised through the bond market, which deals with long-term debt securities such as bonds, and the stock market, which deals with equity securities and stocks. So ang pagkakaiba ng money market and capital market is that yung money market is short term while yung capital market is long term. So dito sa money market, since yung mga funds na nandoon is short term, yung rates na nag-apply dito are generally lower than funds which are available for use over longer periods of time. And yung mga investors who can be individuals or business owners, ina-avail nila itong mga instruments na to or yung mga funds na makukuha sa money market na to because of their liquidity. They are available most of the time when needed and access is present when the business needs them. They are safe as these are quality investments for short periods but do not provide very high returns compared to long-term investments. So, examples of money market debts are treasury bills, commercial papers, money market funds, consumer credit card debt. Yung treasury bills, yan yung mga ini-issue ng treasury or government which matures within 1 year. And it is generally default-free since yung government will exert all effort to pay. Second is yung mga commercial papers. This is issued by financially sound businesses to fund investments in inventories and receivables. And this matures about 9 months and is generally low default risk as businesses have good credit standing. Next is yung money market funds, which is issued by banks or mutual fund companies, and the degree of default risk is low. Next is yung consumer credit and credit card debt, which is issued by banks, credit unions, finance companies, and its maturity date varies, and default risk also varies. And sa capital market naman, which is long-term funds yung nandito, yung interest rate that this debts charge is higher than money market instruments and is usually locked in over the entire life of the debt. Ang example nito is bond, note, and a stock. Next is yung primary markets versus secondary markets. So primary market is where new shares are issued and sold to the investing public for the first time. It is where capital is actually raised by the company selling stock directly to investors, typically through an initial public offering. While yung secondary market is where the original shareholders sell their shares to other investors. So, sa primary market example is that, for instance, if San Miguel Corporation, nag-decide sila na ibenta nila yung new stock nila to raise equity funds. And it will be a primary market transaction since it is the first time na yung company ibebenta niya yung stock niya sa public. And it is called an initial public offering. So the proceeds of the sale go to the San Miguel Corporation, the issuing company. And the investors who have subscribed to the IPO have provided the company with the necessary funds to continue its operation and expansion and become part owners of the company. Sa secondary market naman, diba sabi niya, it is where the original shareholders sell their shares to other investors. So, if you decide to buy existing shares of, say for example lang if you decide to buy existing shares of San Miguel Corporation, and you cannot buy them directly from the issuing company anymore since they have all been sold to the investing public during the initial public offering. So, ang gagawin mo is that for you to avail shares sa San Miguel, investors can only buy these shares from existing shareholders who are willing to sell their shares. So, makaka-avail ka lang ng mga shares from San Miguel kung yung mga existing shareholders ng San Miguel are willing to sell their shares. When they do so, it is a secondary market transaction. The proceeds from this transaction do not go to the issuing corporation. Instead, they go to the investor who sold the shares. The secondary market is where di ba nga, yun, original shareholders sell their shares to other investors. An investor can only make a profit when he can sell his shares at a price higher than the purchase price. This market gives a continuous reflection of the value of securities at some point in time according to the best available information. Private markets versus public markets. So, private markets, this is where transactions are negotiated directly between two parties. While yung public markets naman is where standardized contracts are traded on organized exchanges. So, dito sa private markets, yung mga transactions are negotiated directly between two parties. While sa public markets, maraming parties yung involved dito. Sa private market, bank loans and private debt placements with insurance companies are examples of private market transactions. Because these transactions are private, they may be structured in any manner to which the two parties agree. By contrast, securities that are traded in public markets, for example, common stock and corporate bonds, are held by a large number of individuals. These securities must have fairly standardized contractual features because public investors do not generally have the time and expertise to negotiate unique, non-standardized contracts. Broad ownership and standardization result in publicly traded securities being more liquid than tailor-made, uniquely negotiated securities. That is all, and thank you.